Hello everyone, welcome to the Bowtie Breakdown. I'm Garry Morin, the Bowtie Guy. Thanks for tuning in. Today I am at Primary Residential Mortgage in Cranston, Rhode Island with my friend Steve. Thanks for joining us today and letting us stop by.
Thanks for having me. Appreciate it being here.
So Steve's here to tell us the difference between an FHA loan and a conventional loan. But Steve, before we get into that, can you tell us a little bit about yourself?
So my name's Steven Hawes. I am a senior loan officer. Been doing mortgages about 20 years now. And I say I do loans for homes because I help people buy houses. I help them refinance, buy investment properties, all
So the full spectrum.
Like that. Yep. Anything residential mortgage related I can help you with.
Okay. And have you been with Primary Residential Mortgage the whole 20 years?
No, I haven't. I've been here about a year. I've done a little bit of everything in the mortgage business, so I'm well-rounded in mortgages and been through different markets, so I'm always and willing and happy to help everybody. So,
what is your favorite part about being a lender?
So it's the closing. So I help people buy houses day in and day out, but going to the closing when they finally get the keys,
and everybody's crying.
Yeah, everybody's super excited. That's the best part of the whole process, and I try to go to all my closings because it's the best part.
All right, so FHA loans and conventional loans are probably two of the most popular loans. Can you tell us the general differences between the two?
So when you buy a house, you really have four options. You have FHA, conventional, USDA, and VA.
Okay.
So USDA is for rural properties. Most of Rhode Island, you can't do USDA loans.
It's like west of 295 or something like that.
Certain areas you can. VA, you have to be a veteran.
Yep.
So the most two popular loans are conventional and FHA. And how I explain it is, they are kind of similar. They both help you get into a home. They both have a first-time home buyer option. Conventional, it's 3% down. FHA, it's 3.5% down.
So on the conventional, it's 3% down. So is that new? I was always under the impression that it was a 5% down.
So that's if you have owned a home in the last 3 years. But if you're a first-time home buyer, it's only 3%. And it's been like that for quite a while now.
Nice to know, guys. You hear that? So if you're a first-time home buyer, 3% on a conventional loan, not 5%. So just want to clarify that. Thank you, Steve.
So the main difference is a conventional loan is a better loan financially long-term.
Okay.
So conventional, they work with everybody, but they typically like to work with people with higher credit scores and lower debt ratios. Your debt ratio is how much you got coming in compared to how much money you're spending out.
Is there a certain number or percentage that you look for on debt to income ratio?
Well, conventional, again, likes the lower debt ratios, so they want typically 45% and below of your total income versus your total debt. Now, what that is that your housing, maybe your mortgage payment, your taxes, your insurance, then also any bills that you have on your credit report.
Okay.
So when we pre-approve somebody, we look at your total income, what you're being taxed on, and what's on your credit report. We're not looking at your electric bill, your gas bill, your insurance.
Okay.
So we're just looking at some of those debts, and a lot of times we're going to pre-approve somebody for more than what they actually want to spend.
Yep.
So when I talk to people, I'm asking, hey, what are you comfortable spending monthly?
Yes.
Not how much do you want to buy a home for.
You're approved to $1 million.
Yeah, well, if you're a W-2 employee, we're going to pre-approve you for a little bit more than what you want to spend because of we're using your gross amount, and we're not looking at that cable bill, the electric bill, the gas bill, things like that. So,
okay, so that was the debt to income ratio. You said 45%.
I would say 45%. Now, FHA, they work with everybody. They work with good credit. They work with bad credit. They allow more of your money to go out, so they'll actually go up to 56.99%.
So there's a big difference.
Yeah, there's a big difference. So, but they have mortgage insurance. That mortgage insurance is going to be on there forever if you don't put 10% down. And they have two mortgage insurances. So if you don't put 20% down on a home, you're going to pay mortgage insurance, and that's just an insurance for the bank, basically. If they ever foreclose, they typically only get 20% of their money back. So that's where that insurance comes in.
Their money's backed up.
Yeah, their money's backed up. So now they'll lend more of it.
Okay.
So FHA has two of them. Conventional only has one.
Okay.
And a conventional loan, they'll look at your credit score and then how much money you're putting down. So the higher credit scores, you actually get better mortgage insurance.
Gotcha.
And you're only paying that one mortgage insurance on a conventional loan.
Okay.
And it will fall off when you hit 80% loan to value. So when you get 20% equity, it will fall off automatically. Yeah.
Okay.
FHA, and this is why conventional is a little bit better financial, because FHA, it's going to stay on there forever. So you have a monthly mortgage insurance that's just a flat fee that everybody pays the same, no matter what your credit score. And then they also have an upfront fee, which is called a MIP. And it's an upfront mortgage insurance that they collect. And that's what they'll use to fix up the property if they ever have to sell it, if they foreclose on it. So there's a reason behind the madness. But
it's not just to make extra money.
It's not to make extra money. It's to cover the bills if and when things ever go bad.
Okay, that makes sense. So it seems like you said conventional would be better financially. Is there, like, generally speaking, is the monthly payment usually cheaper?
So it depends. It depends on the person. It depends on
and it depends on you. House,
everybody's situation is a little bit different. But let's just take, for instance, if you're a 680 borrower, you got a 680 credit score. A lot of times FHA is going to be cheaper for you than a conventional loan because of the mortgage insurance.
Gotcha.
Because that mortgage insurance is going to be hefty on a conventional, because
could be like a couple $100, right? A month?
It could be, yeah, it definitely could be. Now, if you got a 770 credit score, totally different ballgame. The mortgage insurance is going to be way cheaper on that loan on a conventional for somebody than it would FHA. And FHA, again, it's costing a little bit more money, and then eventually you have to refinance out of it to get out of that MI. So that's why.
That's the way to get out of it. That's a whole nother video, it sounds like. All right, so now between the two loans, is there, you touched on credit score a little bit. Is there a minimum credit score for conventional, and what is it?
So they're both 620.
Both of them, okay.
Well, FHA, you could actually go down to 580. It's better if you have a 620. Conventional is definitely 620.
Okay.
But you don't want to do a conventional loan at a 620 because the interest rate and the mortgage insurance is going to be so high that it's just not going to make sense.
Gotcha.
Payment's going to be cheaper on an FHA loan.
Okay. So, and that's where you come into play. You kind of guide the people on which option would be best.
I give options. At the end of the day, I'm not making the mortgage payment. My client is. So I say, Mr. Client, these are your options. This is an FHA loan. This is a conventional loan. Unless it's like so far off, I'll just say, hey, look, this looks like your best option. But we discuss everything.
Okay, good.
I do this day in and day out. You do this day in and day out. But you, the client, or you watching this, you're going to do this once or twice or maybe a few times in your life. So we're just here to walk you through everything. And I know you take care of your clients. Just the way I take care of my clients.
That's why I think these videos are helpful. And thank you for sitting down with me, because it really does a lot better coming from the lender than the realtor. I like to stay in my lane and talk about the houses, the contracts, and that type of stuff. So I really appreciate sitting down with you guys, because that's where I learn as well. And obviously the viewers get to see that. Between the two loans there, we talked about minimum credit scores. They're about the same. Does it take the same amount of time to close each loan?
Yeah, it's basically, it takes us 30 to 45 days to get you into the house. You don't really start the mortgage process until you sign your purchase and sales agreement. And in today's market, it's about 30 days from start to finish. We can close a loan in 2 weeks if we need to. But it just depends on everybody's schedule. And there is a lot of people that get into a mortgage or a real estate transaction. You have both agents. You have attorneys. You have an appraiser.
There's a lot of pieces.
Yeah, a lot of pieces, and a lot of people get involved. So there's a lot of moving parts, and it can kind of go up and down. Like, it's super exciting, then it's super stressful.
Roller coaster.
Yes, and I know, like you, I'm here holding my client's hands
from start to finish,
because we're doing this day in and day out. We've been through this a bunch of times, and we're not as emotionally invested, so it's a little bit sometimes it's a little bit easier for us to see clearly. Well, that's where we come in too and kind of explain that to them and help them understand things. And it's just part of the process sometimes.
So talk to me about property conditions. For each loan, conventional and FHA, does the property have to meet certain like standards?
Yeah, so there can't be any construction going on for either one of them. There can't be any like studs for the walls.
Okay.
No construction. FHA is a little bit stricter with the appraisal. They don't want any chip paint. They want railings on the stairs, no broken windows. But in the scheme of things, it's not much different.
Right. It's just basically
more,
has to be livable, basically.
Has to be livable. Conventional is definitely a little bit easier. And again, it just goes back to, everybody's a little bit different. So the property's going to be a little bit different. And our expertise will come in play.
So that was Steve Hawes from Primary Residential Mortgage telling us the difference between conventional and FHA loans. I'm Garry Morin. That was another Bowtie Breakdown. Thanks for watching. Steve, thanks for explaining everything to us. We really appreciate it.
Thanks for having me, and please reach out if you need any help.